Welcome to my channel. I'm Scott, and in this video I am going to walk you through the process of valuing Tellurian stock by analyzing their financial statements and dissecting their financial ratios so we can determine if it's a buy or a sell. Tellurian delivers natural gas to customers all around the world. It is developing a portfolio of natural gas production, LNG marketing, and infrastructure assets that includes an LNG terminal facility. That facility is called Driftwood Terminals, and its associated pipelines are used to commute the gas. The company's current natural gas production assets consist of 9,750 net acres and interest in 74 producing wells located in the Haynesville Shale, which is located in Louisiana. The company entered into 4 LNG SPAs, which is currently part of Phase 1 of the Driftwood Terminal. The company is focused on securing financing for the construction of Phase 1. LNG SPA stands for Liquefied Natural Gas Sale and Purchase Agreement. This is a contract for the sale and purchase of LNG between Tellurian and a company that will transport the LNG by vessel. The company entered into an LNG SPA with Gunvor Singapore Vitol for the purchase of 6 million tons of LNG per year. Tellurian also entered into 2 LNG SPAs with Shell for 3 million tons per year at a price based on the JKM index or the TTF futures contract price. JKM is the Japan-Korea marker, which is a benchmark price that reflects the spot market value of LNG cargo that goes into Japan, South Korea, China, and Taiwan. TTF is the Tidal Transfer Facility. This is a virtual trading point for natural gas in the Netherlands. Each of their 4 LNG SPAs has a 10-year term from the date of the first commercial delivery from the Driftwood Terminal. Sharif Suki is the founder and ex-CEO of Cheniere Energy. He was fired from that company after a takeover by billionaire investor Carl Icahn. He founded this company. Sharif has tons of connections and lots of experience in this sector. The company is headquartered in Houston, Texas, and was founded in 2016. It can be found on the Nasdaq, Deutsche Börse, and London Stock Exchange. Let's get started with the model. This is a small cap company, 1.4 billion market cap. They're trading at $3 a share, and they have 479 million shares outstanding. Let's look at their financials. The way you value a company is you estimate the free cash flows into the future, and then you discount those numbers back to today's value. That's what we're doing in this video. And free cash flow is cash flow from operations minus capital expenditures. So they do have negative free cash flow each year since they're not bringing in much revenue and they're really trying to grow their business. So they're investing a lot back into CapEx. Net income is the profit or loss on the income statement. It's revenue minus expenses, and that's also negative each year. Revenue is the sales for the company, and that was $5 million in 2017. Here's a breakdown of their revenue back to 2017. My model only goes back to 2018. This is the company's income statement. The top line is the revenue, the sales. Below that is the cost of revenue. These are the expenses directly related to generating the revenue. Revenue minus cost of revenue gives you your gross profit, and that is positive every year. Below that is their operating expenses. These are all the expenses not directly related to generating the revenue. Below that is their operating income, which is negative every year. And the bottom line of the income statement is their net income, which is also negative every year. This is the company's income statement from the latest quarterly report. This is the first 9 months of 2020 versus the first 9 months of 2021. And this is the third quarter of 2020 versus the third quarter of 2021. In the third quarter of 2021, all their sales came from natural gas. In the third quarter of 2020, it was split between natural gas and LNG. The way you get LNG, liquefied natural gas, you cool natural gas to negative 260 degrees Fahrenheit. That means LNG is 600 times smaller than natural gas, so it's much easier to transport. LNG is transported by vessel. Natural gas is mainly transported by pipeline. The company did sign those LNG contracts. Revenue should start flowing in a lot once Driftwood gets to full capacity. The cost of sales is $3 million, which is really good margins because their revenue was $15.6 million. Although in the third quarter of 2020, their cost of sales tripled and their revenue declined. They spent $9 million in developing their properties, $3.7 million in depreciation, $14.5 million in G&A expenses. This includes payroll for a lot of their employees. So they do have negative operating income, but it's pretty early on for this company. They're still building out their infrastructure. They spent $16 million of interest on their debt in the third quarter of 2020. That was under $1 million in the third quarter of 2021. So it appears that they paid down a lot of their debt. This is the company's statement of cash flows. The top line is operating cash flow. That's how much cash the company loses from its operational business. They spent $48 million of CapEx in 2019, $25 million in the trailing 12 months. CapEx is investments in property, plant, and equipment. Operating cash flow minus CapEx gives you your free cash flow. So they're using debt and equity to fund their operations. But it looks like they paid down most of their debt in the trailing 12 months. So now they're mainly using equity. They raised $134 million of capital stock in 2018, $100 million in 2020, and $350 million in the trailing 12 months. When a company issues common stock, that increases the shares outstanding. It makes your shares less valuable. This is their cash flow from operations section for the first 9 months of 2020 versus the first 9 months of 2021. This is from their latest quarterly report. The way to calculate CFO, you start with your net loss, then you have to add back the non-cash items on the income statement, then adjust for changes in working capital. So they had a net loss of $74 million. We have to add back $8.7 million of depreciation, $3 million of amortization of debt issuance costs, $4.6 million of stock-based compensation, and they had a cash inflow of $17 million from changes in working capital. Even though they reported a loss of $74 million, they actually lost $39 million of cash flow. In their cash flow from investing section, they had a cash outflow of $23 million from the development of natural gas properties and a cash outflow of $1 million from investments in property, plant, and equipment. In their financing section, they had a cash inflow of $320 million from issuing common stock. It was $74 million in the first 9 months of 2020. They paid down pretty much all their debt in the first 9 months of 2021. They paid down $120 million of debt. So in the financing section, they had a cash inflow of $193 million. This is the equity section of their balance sheet. They have $359 million of equity. They raised $1.2 billion from selling their business, and they lost $900 million from running their business. Let's look at the capital structure. They have $359 million of equity and $2 million of debt. So they're 99% equity and 1% debt. And I gave them the highest whack on Finbox, 9.3%, and that's a discount rate we're going to apply to the future cash flows. We estimated 7 years of future free cash flows. We also estimated a terminal value, which is all cash flows past year 7, that's $2.5 billion. We discounted those numbers back to today using the weighted average cost of capital. We get a value of the company of $1.4 billion. We divide that by 479 million shares. And we get a calculated stock price of $2.99. They're trading at $2.96, so they're trading at a 1% discount. It's a buy according to the model. It's amazing how close my model is to the current stock price. Their annual revenue projection is 48.5%. So I grew their revenue 48.5%. That's how I came up with their future revenue estimates. To get their future free cash flows, I assumed they would have negative free cash flow up through 2024. The average company in their industry converts 24% of their revenue to free cash flow. I multiply their 2026 and 2027 revenue by 24%. That's how I got their future free cash flows. And I multiply their 2025 revenue by 12%. That's how I got their future free cash flow for 2025. Another way to value the company is to value the 9 million tons of liquid natural gas they've already contracted out to a few parties. 1 ton of LNG equals 48,690 cubic feet of gas. So 1 ton of LNG equals 49,000 cubic feet. Currently, 1,000 cubic feet of LNG is trading between $7 and $8. In the past 20 years, the low point was around $4 and the high was about $16. So let's take the low of $4. $4 times 49 equals $195. That's the cost per ton of liquid natural gas at the lowest rate. For 1 million tons, that's $195 million. And they already have contracts for 9 million tons. So 9 million tons is $1.8 billion. If they generate $1.8 billion of revenue in 2027 and convert 24% of that to free cash flow, that would be $421 million. And I'm assuming they would have no free cash flow in 25 and 26. That would value the company at $7.34. That's the most conservative situation. If the cost for LNG went up to $16, they would bring in $7 billion of revenue. If they convert 24% of that to free cash flow, that's $1.7 billion of free cash flow. That would give them a valuation of $30. So both these scenarios are a lot higher than my model. Simply Wall Street's valuation is $16 a share. They're saying it's 81% undervalued. One analyst priced this stock at $7 a share. The spot price of LNG is highly dependent on the profitability of this company. The higher the spot price, the higher the stock will go. LNG is much cleaner and better for the environment than oil. Compared to oil, LNG has a 25% reduction in carbon dioxide, a 90% reduction in nitrogen oxide, and a 100% reduction in sulfur. LNG is a great substitute for oil since most countries are trying to move towards net zero carbons. The stock was trading over $8 a share before the corona crash. It has come up a lot since that low point. It was getting close to $6 a share at one point, but you can see the price definitely moves around a lot. As you can imagine, it has a really high beta, 2.32, so the stock moves more than 2 times the market. It's very volatile. It's gone up 124% in the past 52 weeks, while the S&P is up 25%. The 52-week low is $1.20. The high is $5.76. And the stock is trading well below its 50-day and 200-day moving average. It's a really popular stock. Over 12 million shares are traded each day. Of the 479 million shares outstanding, 384 million are on float, 34% are held by institutions. And it has a pretty high short percentage, nearly 14% of the shares on float are shorted. Their employee count was going up a lot for a few years, but then in 2020 they laid off a bunch of workers. There's lots of insiders selling the stock, and they're selling pretty big lots, 4.5 million shares, 6.5 million, and pretty much all the sales are by one entity, Total Energies. The general public owns 42% of the stock, institutions own 38%, and insiders own 16%. The biggest shareholder is State Street at 6.3%. The CEO owns 6%, about 29 million shares valued at $85 million. Then BlackRock, UBS, and Martin Houston. Let's look at their financial ratios. We can't look at the PE since they have negative net income. Their price of sales is on the higher side since they're not really bringing much revenue at this point. Price of sales is stock price over sales per share, that's 24.3. So investors are paying $24 for $1 revenue. They do have a good price to book since they're raising a lot of capital. Plus they've been paying off a lot of their debt. They're trying to really strengthen their balance sheet. Let's look at their non-current assets. They have $117 million of property, plant, and equipment. This is net of depreciation. $110 million of deferred engineering costs. This is all related to the construction of the Driftwood terminal. Deferred means expenses a company will eventually pay, but they're not due yet. They have a pretty high current ratio and quick ratio of 3.6. Their current assets are cash of $211 million and accounts receivables of $13 million. Their current liabilities are $28 million of accounts payable and $35 million of accrued and other liabilities. They seem to have enough capital to get through the next 12 months without raising any more equity. They had negative $78 million of free cash flow in the trailing 12 months, and they have $161 million of working capital. Working capital is current assets minus current liabilities. So they have $84 million of funding. The best way to look at ratios is to compare them to companies in the same industry. I've done videos of 17 companies in the same industry as Tell. We can't look at their PE since they have negative net income. Their price to sales is a lot worse than average. They have a much better price to book than average. They have a high current ratio. Most companies in this industry have negative earnings, so their ROE is actually better than average even though it's negative 24%. They pretty much have no debt, and they're a really small company, 1.4 billion market cap. The average is 8.3 billion. So to summarize, I have them trading at a 1% discount. But there's lots of potential with the Driftwood project. The stock may easily 5, 10, or even 20x. The problem is you may have to wait a few years for that to happen. And as you know, there's no guarantees in life. I rank their free cash flow as 1 out of 10, their revenue 5 out of 10, and their ratio is 2 out of 10. So let me know what you think. Give this video a like, subscribe, or comment below. Also, if you'd like to get a custom valuation or just support the channel, you can become a member by clicking on the link in the description below. Thanks for watching.